Hi, my name is Roy, and today we will be diving into fundamental analysis and some key terms you need to know. But before we get started, make sure to like this video, subscribe to the channel, and hit the notification bell so you don't miss out on future content. So let's dive in. What is fundamental analysis? Fundamental analysis is simply studying real-world events like inflation, interest rates, elections, and oil prices to predict where a currency is headed. It is the art of minding other countries' business professionally because when economies move, currencies tend to follow. While others guess and hope, the fundamental analyst reads the signs, plans ahead, and cashes the money before the rest even realize what's happening. What is interest rate? Interest rate is the cost of borrowing money or the reward for saving money. It tells you how much extra you must pay when you borrow money and how much extra you will earn when you save or invest. When interest rates are high, borrowing money becomes expensive. People borrow less, spend less, and save more because saving now pay you better. When interest rates are low, borrowing becomes cheap. People start rushing in to borrow money and then spend like there is no tomorrow, and the economy moves faster. Now for forex traders, interest rates are like the traffic light. High interest rate means green light. That means foreign investors rush in, buy the naira, the dollar, or whatever currency has better return. And then low interest rate means red light. Investors quickly pull out their money and they vanish. What is inflation? Inflation is the general rise in prices of goods and services over time, which means your money buys less than it used to. In simple English, today 5,000 naira can fill a shopping bag. Next year, that same 5,000 naira might not even buy you bread and sardine. That's inflation, the silent thief that reduces the value of your money. The CBN, Central Bank of Nigeria, try to control inflation to keep the economy stable. If inflation is too high, they might raise interest rates to reduce spending. If inflation is too low, they might lower interest rates to boost spending. What is GDP? Gross Domestic Product. GDP is the total value of all goods and services produced within a country over a specific period, usually a year or a quarter. It measures how big and how healthy a country's economy is. In simple English, GDP is the scorecard of a country's hustle. How much goods they produced, how many services they delivered, how much total business the whole country did. If GDP is growing, the economy is healthy. People are working, businesses are booming. If GDP is shrinking, the economy is sick. Jobs vanish, businesses cry, people suffer. What is employment rates, NFPs, and unemployment rates? Employment rates measures how many people in a country have jobs compared to how many want to work. A high employment rate means most people have jobs, which is good for the economy. A low employment rate means many people are jobless, which is bad for the economy. Now, NFP, it stands for non-farm payrolls. It is a major US report that shows how many new jobs were created, excluding farm work, government, and a few other sectors. NFP is super important because it tells traders how strong the US economy is. Unemployment rate is simply the percentage of people looking for jobs but can't find one. If NFP numbers are good and unemployment rate is low, the economy is strong. The US dollar usually gets stronger. If NFP numbers are poor and unemployment rate is high, the economy is weak. The dollar usually weakens. What is trade balance? Trade balance is the difference between the value of a country's exports, that is what they sell to other countries, and imports, what they buy from other countries. If a country exports more than it imports, it has a trade surplus, which is good for the currency. If a country imports more than it exports, it has a trade deficit, which can weaken the currency. So, strong trade balance is equal to stronger currency. Weak trade balance equal to currency go weak. Central banks and monetary policies. Central banks are the top financial authorities of a country, like the Nigeria CBN, the America's Federal Reserve, or the European Central Bank or Europe Central Bank. They manage the country's money, control inflation, set interest rates, and stabilize the economy. Monetary policy is the plan and action that central banks use to control the money supply, interest rates, inflation, and employment. There are two main types. We have the expansionary monetary policy, that is, pumping more money into the system, lowering interest rates to boost spending and jobs. And we also have the contractionary monetary policy, that is, pulling money out, raising interest rates to cool down inflation and control over spending. That's all for now. Don't forget to like this video, subscribe to the channel, and click the notification bell so you'll be the first to know when new videos drop.